Good morning. My name is Ruggiero Lomonaco, Head of Real Estate Funds at Rasmala Investment Bank. Today is the 9th of February 2023, and we are going to talk about financial illusion. Over the last few months, I have come across an interesting theory that inflation might surprise us all on the upside for three major reasons. Demographic changes are causing a shortage of labor, which is pushing wages up. Fractures in a globalized world are disrupting international trade and supply chains, increasing production costs. The transition to renewable energy requires a duplication of power production capacity, reducing efficiencies and increasing costs. Normally, I don't give too much attention to these out of consensus views, but in this case, I felt compelled to investigate further because these statements were made independently by none other than KKR, JP Morgan, and CBRE. As such, I've made a point to regularly check inflation swap curves on my Bloomberg terminal to see whether the market is starting to price these views. Currently, I see a relatively benign inflationary pattern in the USA and the EU, where inflation is expected to be around 2.5%. This is starting from 2024, and stay there for the long term. Only in the UK, inflation is projected or is priced in the market to remain uncomfortably high, above 3.5% for a very long period of time. But let's see a little bit more in details these arguments which seem to point to a possibility of a higher inflation. So starting with the demographic changes. Now here, over the last few weeks, I have also refreshed my knowledge of demographic pyramids of major developed countries. And after I saw that the headlines that the Chinese population had started to decline. So now, in respect to the USA, here is the first chart. I saw a relatively healthy demographic profile with a population projected to increase all the way to 2100. So also the retirement of the baby boomers, which is talked much about, does not seem to be a real issue, as the younger population seems sufficiently large in number to support the economy. Also, the USA has an active immigration policy, which continues to encourage the highly skilled migrants. But as we see in the headlines, they are less open to unskilled migrants from Central and in South America, and this is an issue with labor cost. Now, the only worrying thing that I noticed, this is the bottom right quadrant, which I saw in the research from KKR, was this permanent shift downward of the labor force caused by COVID. It seems that a large number of individuals who would be otherwise expected to participate in the workforce have simply decided to stay at home, causing labor shortages and pushing wages up. Theories abound, from excess savings accumulated by the cash transfer as a result of the cash transfers during COVID. These were cash transfers to individuals who have simply decided to move back with their parents and live off their pensions. Nonetheless, the labor shortage is real and job openings continue to exceed available number of workers, leading to an extremely low unemployment rate, which, as per the traditional Phillips curve, is inflationary. Now, moving to the United Kingdom. So the demographic profile of the United Kingdom also did not seem particularly worrying, with a relatively young population compensating for the lack of participation of retirees and those that are expected to retire over the next 10 years. Now, nevertheless, we do hear about labor shortages in the UK, especially in certain industries like hospitality and construction, which have been negatively impacted by non-British citizens leaving the country following Brexit and during COVID. The data which really caught me by surprise was Germany, the powerhouse of Europe, where I found that the population has actually started to decline last year, and where there seems to be an imbalance between the number of 55 to 64 years old, which will retire in the next 10 to 20 years, and the number of the younger cohorts. There seems to be some comfort on the fact that Germany welcomes mass migration from conflict zones like Syria and Ukraine and has a relatively good system to integrate and assimilate non nationals. Nonetheless, the situation is not bright and needs to be monitored carefully. China was not a surprise because I was aware that the one child policy implemented during the 80s all the way to 2015 was one day going to be halving the population. I was, however, not aware that the decline actually started this year. According to conventional wisdom, China is supposed to change from an export led economy to a consumer led economy, driving the growth of export led economies like Germany. A rapidly aging Chinese population does not really match this conventional wisdom, as retirees, by definition, have less disposable income of those in the prime of their active life. Prospects for family formation and childbearing are also not very bright, as hundreds of millions of people have migrated from the countryside to coastal cities and live in crowded conditions which are not exactly conducive to upbringing children. So I won't be surprised if strategists start to rethinking the role of China and Asia altogether as the future engine of growth of the world economy over the next few years. So from what I've been reading, and in this I've strayed away a little bit from the material produced by the Wall Street Economist. So what I've been reading, China and Asia were late to the industrialization party and may not have enough time to transition from an export-led growth model to a consumer-led one in an increasingly deglobalized world. So if I were asked my personal global allocation preference, I would say USA first, selectively Europe, preferably Northern Europe and the UK, and only a small allocation to Asia, preferably limited to liquid markets to make easy an exit in case things deteriorate faster than expected. Now, the next thing that I've been researching and reading about is this process of deglobalization, of slowing of the globalization. This has not been very much in the headlines, but really, it's starting to become more and more important topic. I mean, just yesterday I received in my inbox a blog from the IMF talking specifically about this topic and charting the process of slowing of globalization for the time being. Also yesterday there was the State of the Union address from the US president, and even there I hear the US president talking about slowing down the transfer of advanced technologies to ensure that this technology is not used against the United States. So there is certainly an attention at the highest level about the fact that globalized world has empowered other countries other than the US and the Western Bloc to grow and challenge that leadership. And as this leadership is challenged, the US is retrenching, and that is creating fractures in the globalizations. Where do we see these fractures? How do we measure them? Well, it is in global trade. So how important is global trade to the functioning of the global economy has become more than apparent during the recent pandemic, healthcare pandemic, when global supply chains were highly disrupted, causing shortages everywhere, and that was the cost of which was the initial cost of the inflation. Now, as a result of that, and more recently following geopolitical tensions in Eastern Europe and Northeast Asia, many companies have started to reconsider their supply chain. something which has resulted in two major trends: increasing stockpiling of raw materials and intermediate goods near home markets, and reshoring or near-shoring of production, with obvious inflationary implications. Because shifting from a just-in-time to a just-in-case mode of production increases the amount of inventory that needs to be maintained at any point and the associated cost. Shifting production from geographies with a low cost of labor to those closer to the end user markets. This is being referred to Industry 4.0, increases the cost of production. And here now we move to the third topic of discussion, which is the cost of transitioning to renewable energy. Now, it has now become accepted wisdom that producing energy from fossil fuel generates greenhouse emissions, causes global warming, and ends up in climate change with all the economic impacts. What is less commented on is the cost of transitioning to renewable energy, both in financial terms and in terms of carbon emission itself, because the materials required to build wind and solar farms and storage batteries require a huge input of energy from fossil fuels, over and above normal demand to support our economy. Energy transition is inflationary because while we are installing renewable energy production capacity, we still need a full backup of traditional energy generators to avoid that we end up with blackouts. Just consider how fast Germany had to rush to replace their gas supplies when it became evident that Russian gas would have stopped this winter. Clearly, renewable energy generation installed in the country was nowhere near to provide energy independence. As such, building a parallel infrastructure to producing renewable energy is going to be highly inefficient. It is going to be a very highly inefficient way to invest capital and will eventually be inflationary. Now, here is my conclusion for the impact of an inflationary environment on financial markets and in particular to real estate and infrastructure. So high inflation has meant higher interest rates and the return of fixed income and at the top of investors' preferences. After all, why bother with risky assets when your bank is offering you 5 or even 6% yield on a fixed deposit? Unfortunately, this is just what is called in economics a financial illusion or monetary illusion. So people usually tend to measure wealth and income in nominal terms, i.e., how much money do I have, rather than in real terms, i.e., what I can buy with the money that I have. And if indeed inflation is going to turn out higher than expected, holding too high a portion of the portfolio in fixed income assets might end up in a loss of real purchasing power. Just think what happened to bank deposits in the 70s and the 80s. Personally, after I have allocated a portion of my portfolio to cover the immediate cash requirements for the near future, that could also mean setting aside money for a rainy day, which I don't mind keeping in fixed income instruments, for example, Sukuk. I would rather invest in assets with growing income, like real assets and equities. Now, here is a visual explanation of the difference between investing $100 in fixed income and $100 in growing income. Using rates, I've taken rates from the US swap curve and average rental yields in US properties, assuming that this grows in line with the current inflation. Well, I think that the chart is clear enough that where my income will be in 20 years if I invest in one or the other. So I wish a good rest of the week, and if you would like to discuss in more details this topic, feel free to call. Bye-bye.